Afternoon. Hopefully you all are doing well. Want to talk to you today about navigating homeownership after Chapter 7 bankruptcy. Thinking from the context of wanting to buy a home, these are the time intervals that you should think of. You need a 12-month history from the discharge date to reestablish your credit history. You can put your rental history on your credit report to establish a credit history for those of you that did not have any. Your number one tier is always going to be your rent or your mortgage payment. Also want to make sure is that payment that you're making matches the lease agreement. Do not pay anything in cash. Cash is not your friend in this instance because we're trying to establish a history, and documentation is always key. After you've established a rental payment history, from there, revolving lines of credit, credit cards. There's a ton of information out here where you guys can get a secured card after a bankruptcy. Here is what you need to know about any type of revolving credit card. Utilization, that's the term, how you utilize the card. And then from utilization, you want to be known as a transactor and not a revolver. A revolver or is someone that keeps a balance and just pays monthly. That's who the credit card wants, but we're educating and learning how to win in this game. So we want to be a transactor in that we pay off that balance every week. That's what I would advise. Every Friday or one day a week where you can sit down and pay off whatever it is that you've utilized. And then as far as the utilization, you never exceed 9% of whatever the available credit limit is. If you do that, I guarantee you that portion of your credit will be stellar because you're utilizing it the right way. You're not overutilizing, you're not overextending. And then you're paying off the balance and not paying interest because we don't want to get back into a bankruptcy situation. The last thing you want to do, and a lot of people don't do, especially after having negative events, you want to hide, but you really need to monitor your credit. Okay, what gets measured, that's what's paid attention to. The CFPB, Consumer Financial Protection Bureau, allows for us as consumers to go to myfreeannualcreditreport.com to be able to, at minimum, once a quarter, once a year, look at one of the agency's reports to see what information they are collecting on us individually to make sure there are no inaccuracies. You shouldn't find out about things for the first time when you're getting ready to apply. In this case, these are things that we have to be proactive about. And so as we're reestablishing ourselves after a Chapter 7, if you've gone through one of those things, following these steps to reestablish yourself, documentation, utilizing the credit cards properly with the right percentages of the available credit limit, and then checking up on our information via Experian, TransUnion, and Equifax regularly, being proactive and not reactive is really the key. There are mortgage or home loan options for you after bankruptcy. From a 10,000-foot view, all of your government insured loans, FHA, USDA, VA, are always going to have the most favorable waiting periods after a Chapter 7 event. But even conventional loans will offer someone who has reestablished themselves and waited the required time. With conventional, it's 4 years after the discharge date. And over that 4-year period, if you're going to go conventional, we got to make sure that we've done everything that I spoke about in the prior slide as far as reestablishing ourselves. And so if we're going to wait 4 years, we should have a 4-year history of we're back on track. And whatever was going on that caused the bankruptcy is behind us. You cannot have late payments after having a fresh start, a Chapter 7. So if you're going to go conventional, you're going to wait the 4 years, make sure that there's no late payments, none, after the time that the bankruptcy was discharged. So keep that in mind. FHA and VA offer the shortest period of time of waiting after a Chapter 7. Actually, with FHA, if you have a valid extenuating circumstance, something that could be documented. As an example, one of the applicants had a pre-existing condition that eventually led to a heart attack. And as a result of that heart attack and those the pre-existing conditions, they were not able to get insurance. And so the medical bills were just mounting up. Then they had the heart attack, and it was just overwhelming. The chapter 7 came in and wiped everything off. And since then, that person has been stellar. So if you have a valid extenuating circumstance, like a death of a primary wage earner or a medical condition that we can document, you can get back on the property ladder as soon as 1 year after the discharge date with a valid extenuating circumstance. There's going to be a manual underwrite, but we're going to be fine because if you follow my steps from earlier, you're going to put that rental payment on the credit report. It's going to match the lease amount. Now we're documenting rental history, tier 1. Tier 2, if you can add some utility bills, lights, water, cell phone bills, insurance, something that you're paying regularly, if you could put that on the credit report. But even if you can't, we can document it, no late payments or anything of that nature. We got tier 2, okay? Then we're going to have some type of secured credit card or a regular credit card. Doesn't matter the available credit limit. We're going to keep it at 9% or less of the available credit limit, and we're going to pay that balance off every month on a certain interval. We're not getting into debt. We're beyond that. We're not living on the credit card. We're using it to help us. By the time you get to that 1 year with FHA, if you have a valid extenuating circumstance where we can document, boom, everything else is in line, and you'll be able to move forward. Do it all the time, I guarantee you. USDA, 3 years. So conventional, 4, waiting period. USDA, 3. FHA can go as early as 1 year with a valid extenuating circumstance. Otherwise, 2 years for FHA and VA. And out of all of them, VA is probably the most lenient as far as the VA we want to help veterans get into homes. And so it just almost has to be that you're dealing with somebody that doesn't know what they're doing, or you're just somebody that was an abuser of your credit. There was really no excuse or reason behind it for you not to be able to do a VA loan. So those are the loan options that are available. And that's all of the options, even on the conventional side. Again, it's about your information and reestablishing yourself with proof, with documentation, showing that whatever was going on is behind you. Now, I'm going to give you a couple of things that you should keep in your back pocket to help you move forward. That rent that we spoke about, you want to not exceed 1.5 times, 150% times the current rent that you're paying. As an example, say you're paying $1,000 a month. Your house payment really shouldn't exceed $1,500 a month, okay? You should be able to absorb that payment shock and be very successful in a home. So $1,000 a month rent, you should pay no more than 150% of that, or $1,500 a month. And I'm talking principal, interest, tax, assurance, homeowner association fee. Well, I don't know where you're buying a house like that. There's plenty of them out here. Trust and believe. You might have to look, you might have to change, you might have to go out a little further. Just depends on where you are, because our real estate is local. Don't let these folks online tell you that everything is $500,000. It's just not true. But we're here to learn how not just to buy a home, but to be successful homeowners, and then derive all the benefits that come as a result thereof. One of the main things that I'm seeing with folks, not just coming after bankruptcy, but people in general, is you're buying too much home. And it's not just about the monthly payment, but it's about the maintenance, the upkeep, the things that come with the home. So you don't want to overextend yourself. So long story short, when you're getting ready to buy, no more than 150% of what you've been paying in rent. The only time I'm comfortable with you exceeding that is, say you have a partner or some other folks that are going to help you pay, and for whatever reason, we're not using them to qualify for the loan, but there's additional income. To do so, you have to review your finances, understand your monies, what's going on. Again, we're going from a mindset of just having things happen to us to where we're proactive now, especially after this bankruptcy. So we have a budget. We know exactly how much is really coming in, because from a lending standpoint, we're qualifying you on the gross, but you live on the net. So these are things that you have to know and understand in order to put yourself in the best position to succeed. Secondly, After you've done all those things, you understand your income, your true expenses, your debt to income ratio. Let me give you some parameters on that. Your front end ratio, I'll be generous but conservative, 34%. How do you calculate a front end ratio? Let's say you take that $1,500 house payment, that's your housing expense, and you divide that into your gross income. That ratio is the front end ratio, shouldn't exceed 34%. And I think that's a good number now with inflation. The back end, really, you could go as high as 50, but I mean, you're coming out to chapter 7. I think you ought to be conservative. So let's say front end 34, back end 45. Okay, you possibly could go a little higher. Got to get with your lender, talk about your specific situation. I'm just giving you some parameters. So 34, 45, those are your ratios. Front end, just the housing payment portion, PITI, divided into the gross income. And then the back end, we take the house, PITI, plus the monthly expenses that show up on your credit report, the minimum payments. Add that together, divide that into the gross. Shouldn't exceed 45 if you want to be real conservative. So you understand your debt ratios. This will help you determine your affordability and your budgeting needs, because it's just not making the house payment, but the upkeep, the maintenance that goes along with the home. That's how you prevent yourself from having buyer's remorse. Then and only then, after we've done all that and you understand where you really are, now it's time to reach out to that lender that you know, like, and trust, so that we can go through not just the pre-approval process, but the approval process. Because if it's not been 7+ years and you're applying and you've filed and successfully been awarded a Chapter 7, I guarantee it's going to be a manual underwrite. So that's why we got to have all these things in place. That's when you reach out to the lender that you know, like, and trust to actually be approved, and you're going to present all of that information. Therefore, when you are approved, you can go out and shop with your realtor with confidence. None of this 5-second stuff. And that really goes for anybody, bankruptcy or not. One other thing too, and I probably got these out of order, you should be reviewing your finances from there. You want to save for a down payment, right? Then you want to go out and get pre-approved, but doesn't matter. It's on that slide. How much should you be saving? At minimum, 3.5%. Why 3.5? Because that's FHA's minimum down payment. It's going to take you anywhere between as little as nothing, depending on your deal and your loan type, up to 10% conservatively of the purchase price. Again, minimum 3.5% saved of the sales price. The more the better. Okay, the more the better, but minimum that, because even if you don't have any monies out of pocket, you got a great deal, the seller's paying the closing cost, whatever, you have those monies left over. And the goal should be you have 3 months minimum of your PITIA, principal, interest, tax, insurance, and association, if it's applicable, in an account that you can physically touch after closing. So if that example is a $1,500 mortgage payment with principal, interest, taxes, and insurance, you should have $4,500 checking, savings, money market somewhere that is your money after closing minimum. Because we're not just trying to get you in a home. We're trying to help you build that generational wealth, and you got to keep the house, you got to maintain the home, and all those things to get those benefits that are going to come down the line. Now we're securing the financing and the loan approval. This is where we're going to review your credit, and you're going to be getting an attaboy or attagirl, good job, great job on all the work that you've done beforehand before getting to this point. Right? And you should know that you should be able to apply with confidence because you followed these steps. Then we're going to vet your income. Okay. One thing with income, and I'll do another video at another time, but there's a lot of different income types. And you always want to be very conservative with your income and just use your base income. Overtime, bonuses, commission, we have to average that over 2 years. So that's not for you to do. That's for your lender that you know, like, and trust. But that's why it's very important to submit a complete application and not a soft pull and look at a credit report and then you go under contract and have earnest and option money at stake only to find out that you were never approved. We're teaching you how to be educated consumers and know what it is that you need to know enough to be able to move confidently or to be able to pick and choose the professionals that you need to work with so that you know that they're putting you in the right position. And when they tell you approved, You can feel confident about that because you understand the process. But then we'll vet the income, right? Your financial documents, income, assets, make sure we can use all the monies that you saved and it's come from the right place, so on and so forth. But this is the part on you, that documentation of the bankruptcy. Even if you're not trying to go 1 year with FHA, we want to document, you know what happened. You can establish prior to this time, everything was working, and then this happened, divorce or whatever. Or I was immature and negligent and didn't really understand, or whatever the case is. The truth always works. And then you establish, hey, I've done these things from this point, and now I'm here, and we don't have that issue anymore. Letters of explanation should be no longer than a page, very succinct and to the point. And you should always let your lender, your loan officer, review and vet it, not to tell you what to say, but not to put anything in there that's going to hurt yourself. Because we're not breaking any rules. We're gonna live and move within the guidelines, but some things don't need to be disclosed. That's for your professional to be able to advise you. So you got to trust your professional. When you've done all of those steps that we just aforementioned, you should be moving closer to becoming a homeowner. As always, guys, I appreciate you letting me bend the ear. You guys be blessed. Continue to let grace abound. And God willing, we'll see you again soon. Peace.